Hello, this is Chuck Carnevale, and I'm the Chuck and the market's up, Chuck. If you're an investor looking for growth and income, I might suggest you might take a look at Whirlpool, the world's largest appliance manufacturer. The company was recently featured in Barron's magazine on July 15, 2017, under the title Why Whirlpool Could Rise 35% in the Next Year. So with this video, I'm going to take a Fast Graphs Fundamentals Analyzer software look at the company and why I believe that Barron's is correct. When you look at the long-term operating history of Whirlpool, you really see a tale of two companies. From 2001 going forward into the Great Recession of 2008 and 9, Whirlpool was really kind of a flat company. They did pay a dividend, but I also want you to notice that that dividend stayed very flat during this period of time. They paid $1.72 from 2004 through 2010. But look what's happened as we came out of the housing crisis, which obviously stimulated the Great Recession. Look how Whirlpool's earnings growth has really accelerated since that time. Instead of growing at 7% a year, since 2012, the company's earnings growth has averaged over 14% a year. Next, let's take a look at how stock price has reacted to that operating history. You can see a lot of volatility and a real drop in price when they had this moderate earnings crisis during the Great Recession. But you also see this price surge since the Great Recession that coincides with the company's recent surge in earnings growth. Consequently, I believe the stock, like Barron said, is very undervalued today, offers a 2.1% dividend yield. And I think this is a real important factor. As I talked about, they had froze their dividend for many years, but more recently the dividend has grown by double-digit rates. It's increased from $2.38 in 2013 to $3.90 last year and estimated to be $4.30. One of the reasons for this would have to do with operating cash flow and free cash flow. In addition to generating good earnings growth, Whirlpool is also generating significant operating cash flow, more than adequate to cover their dividends, and even better yet, free cash flow has been on a surge as well in recent years. And the company's dividend is also extremely well covered by free cash flow, and that's cash flow that's left over after what they need to run their business. But going back to operating earnings here, I do want to be clear that this orange line represents a PE ratio of 15.5, which is consistent with the company's growth rate since 2013. That's a fair valuation reference. In essence, that's what the stock ought to be trailing at if the market was pricing its fundamentals correct. When you do add monthly closing stock prices, you can see that there is a strong correlation with that. And from a normal PE ratio, the company has traded at an average normal PE over this time frame of about 14. But no matter how you measure this, the stock is significantly undervalued. If these estimates turn out to be correct, there are double-digit return potential on Whirlpool going forward. So let's move on now and take a look at the future. Moving on to the forecasting calculators, let's look at what the analysts are thinking about this stock. There are 11 analysts forecasting earnings growth in 2016 to come in at 13.7%, which it did. And then there are 13 analysts forecasting 2017 earnings to grow by 7.5%. However, analysts are more optimistic going beyond 2017 and forecast almost 14% growth for 2018. And from there, the analysts drop off. Let's just assume that these analysts are correct. That's an average growth rate of around 10%. And this would generate a 25% rate of return if the stock traded at a fair value PE ratio of 15. So there's a lot of opportunity here in the short run. So many stocks are overvalued today, but Whirlpool looks like one that's very cheap. A couple of points I'd like to talk about relative to their fundamentals, and I'll turn to the fund graphs here, the financial underlying numbers. And I want to take a look at a couple important metrics. One is gross and net profit margin. Their net profit margins have actually been increasing rather nicely here in recent years, but it is a low margin business. Appliances don't generate a lot of net margin, but their gross margin is in the double-digit range. But in addition to gross and net margins, I think you also ought to take a look at return on equity, and the company's generating very good returns on equity. So the bottom line here is that I think Whirlpool looks very attractive. They have a reasonable amount of debt, 35% debt to capital. The company's shares, I believe, are currently undervalued, and their earnings growth has really surged in recent years. So anyone who's looking for a total return investment with a nice dividend kicker might want to take a closer look at Whirlpool. This has been Chuck Carnevale saying thanks for watching. I'll see you again soon.